Have you noticed insurance rates doubling, taxes climbing, interest rates refusing to come back down? Well, guess what? That perfect storm is setting the stage for one of the biggest multifamily resets we've seen in decades. Over the next 12 months, a wave of small apartment buildings could be heading straight for foreclosure. But here's the twist. It's not just doom and gloom. If you're prepared, this storm might be your opportunity of a lifetime. Now let's break down what happened. First, insurance costs. After major storms, floods, and disasters across the country, insurance companies have been bleeding money. Their response? Jacking up those premiums sometimes by 30, 50, or even 100% in a single year. That means an owner who budgeted $2,000 a door might suddenly be paying $4,000 a door. That crushes cash flow. Second, property taxes. Cities and counties are desperate for revenue. And since real estate values shot up during the COVID boom, assessments have followed. Owners are getting bills they never underwrote for. Now imagine planning for a $50,000 tax bill, only to get hit with $75,000. That's not just painful, it's devastating to your NOI. And third, interest rates. Cheap debt was the fuel for this fire. We might as well put gasoline on it. 2, 3, 4% interest rates let syndicators and small buyers stretch, overpay, and still make those numbers look good on paper. But when those bridge loans expire, when the floating rates reset, suddenly they're staring at debt service payments that are double what they were before. The math just stops working. So why are we in this mess? During the 2020 through 2022 period, people overpaid. And I don't mean just by a little bit. Syndicators were raising millions of dollars, promising investors 18, 20% returns, and competing with each other to buy deals at a record low cap rate. Small buyers, new to the game, jumped in too, thinking multifamily was a guaranteed win. But here's the problem. They bought based on pro forma fantasy, not actuals. They assumed rents would always go up, and they assumed expenses would stay flat, and they assumed debt would stay cheap forever. Now here's a reality check. Rents in many markets have flattened. Expenses have exploded, and the debt environment has completely flipped. And the result? Properties that looked like gold mines 2 years ago are now financial quicksand. What happens when insurance doubles, taxes spike, and your mortgage payment balloons? You can't pay the bills. Your debt coverage falls below the lender requirements. You can't refinance it because your property isn't worth what you paid, and when you can't refinance, you are stuck until the lender steps in. This is why foreclosures are coming. Not just for the big guys who did massive syndications, but especially for the small multifamily owners who were stretched too far. Those duplexes, 10 units, 20 units, and even those 40 units bought at the peak are now under stress. And here's the kicker. When one owner can't make it work, it ripples. Distressed sales hit the market, comparable values drop, suddenly everyone's appraisal comes in low, and it's a domino effect that pushes more and more properties towards default. Now let's flip this around, because every storm has a silver lining. If you're a buyer today, this market shift could be your chance. Sellers who overpaid are about to become motivated sellers. Lenders who foreclose don't want to hold these properties. They want them off their books. That means discounts, creative financing opportunities, and deals that actually make sense again. Think about it. 2 years ago, everyone was paying $100,000 a door. Now you might scoop it up for $80,000. With higher interest rates, yes, you need to be cautious. But when you buy right, your downside is protected, and your upside when rates stabilize or rents recover is massive. This is where smart investors separate from speculators. While others panic, you position yourself to acquire at true value, not that inflated hype. So here's the takeaway. The trifecta or hurricane of insurance, taxes, and interest rates is breaking deals across the country. Over-leveraged buyers and syndicators who thought the party would never end are about to face reality. But if you're patient, disciplined, and prepared, you can step into the chaos and build that generational wealth. Don't be the one who bought high and got crushed. Be the one who waited, studied, and struck when the timing was right. Because fortunes are made in the downturns, and this downturn, it's already here.